Welcome back. So today we're going to discuss about short sale. What is a short sale or what's short selling? Traders may use short selling as speculation, and investors or portfolio managers may use it as a hedge against downside risk of a long position in the same security or related one. So speculation carries the possibility of substantial risk and is an advanced trading method. So hedging is a more common transaction involving placing an offsetting position to reduce risk exposure. In short selling, a position is opened by borrowing shares of a stock or other asset that the investor believes will decrease in value. The investor then sells these borrowed shares to buyers willing to pay the market price. Before the borrowed shares must be returned, the trader is betting that the price will continue to decline and they can purchase them at a lower cost. So the risk or loss on a short sale is theoretically unlimited, since the price of an asset can climb to infinity. So let us understand short selling. With short selling, a seller opens a short position by borrowing shares, usually from a broker dealer, hoping to buy them back for a profit if a price declines. Shares must be borrowed because you can sell shares that do not exist. To close a short position, a trader buys the shares back to the market, hopefully at a price less than what they borrowed the asset, and returns them to the lender or broker. Traders must account for any interest charged by the broker or commissions charged on trades. To open a short position, a trader must have a margin account and will usually have to pay interest on the value of the borrowed shares while in position is open. Also, in the financial industry, it enforces the rules and ensures that they must follow those different guidelines. Why sell a short? The most common reason for engaging in short selling are speculations and hedging. A speculator is making a pure price bet that it will decline in the future. If they are wrong, they will have to buy the shares back higher at a loss. Because of the additional risks in short selling due to use of margin, it is usually conducted over a small time horizon and is thus more likely to be an activity conducted for a speculation. People may also sell short in order to hedge a long position. For example, if you own call options, you may want to sell short against the position in lock in profits. Or if you want to limit downside losses without actually exiting a long stock position, you can sell short in a stock that is closely related or highly correlated with it. Let's look at an example of short selling for a profit. Imagine a trader who believes that XYZ stock, currently trading at $50, will decline in price in the next 3 months. They borrow 100 shares and sell them to another investor. So the trader is now short of 100 shares since they sold something that they did not own but had borrowed. The short sale was only made possible by borrowing the shares, which may not always be available if a stock is already heavily shorted by the other traders. So a week later, the company whose shares were shorted reports dismal financial results for the quarter, and the stock falls to $40. The trader decides to close the short position and buys 100 shares for $40 on the open market to replace the borrowed shares. The trader's profit on the short sale, excluding commissions and interest on the margin account, is that's how we look at you get the $100 and then you, in brackets, you look at the $50 that we had looked at minus the $40 equaling to $10 times 100 shares, and the total equaling to $1,000. Example of short selling for a loss using this very scenario we've looked at. Let's now suppose that the trader did not close out the short position at $40 but decided to leave it open to capitalize on the further price decline. However, a competitor swoops in to acquire the company with a takeover over $65 per share, and then the stock soars. If a trader decides to close the short position at $65, the loss on the short sale would be the $15 in brackets $50 minus the 65, which definitely will equal to a negative $15 times 100 shares, totaling to $1,500 losses. That would be a negative. Here, the trader had to buy back the shares at significantly higher price to cover their position. In conclusion, let's look at the pros and cons of short selling. Selling short can be costly if a seller guesses wrong about the price movement. A trader who has bought stock can only lose 100% of their outlay if the stock moves to zero. However, a trader who has shorted stock can lose much more than 100% of the original investment. The risk comes because there is no ceiling for a stock's price. It can rise to infinity and beyond. To coin a phrase from another comic character, Buzz Lightyear also said, while stock was held, the trader had to find the margin account. Even if all goes well, traders have to figure out in their own cost margin interest when calculating their profits. Looking at the pros, there's a possibility of high profits, little initial capital required, leveraged investment possible, hedge against other holdings. And then the cons, potentially unlimited losses, margin account necessary, margin interest incurred, short squeezes. When it comes to time to close the position, a short seller might have trouble finding enough shares to buy if a lot of other traders are also shorting the stock, or if the stock is thinly traded. Conversely, sellers can get caught in a short squeeze loop if the market or particular stock starts to skyrocket. On the other hand, strategies that offer high risk also offer a high yield reward. Short selling is no exception. If a seller predicts the price moves correctly, they can make a tidy return on investments. Primarily, if they use a margin to initiate the trade, using margin provides leverage, which means the trader did not need to put up much of their capital as an initial investment. If done carefully, short selling can be an inexpensive way to hedge, providing a counterbalance to the other portfolio holdings. So beginning investors should generally avoid short selling until they get trading experience under their belt. Yeah. And that being said, short selling through ETFs is somehow safer strategy due to lower risk of a short squeeze. That's the end of my presentation. Thank you.